Hello, today we're going to talk about inventory and cost of goods sold and the multi-step income statement for merchandisers. Little background, a merchandiser is a company that buys products to resell. Okay, we have wholesalers are merchandisers. They purchase directly from a manufacturer and then the wholesalers sell on to other retailers. Retailers are also merchandisers. Retailers are companies that sell to the end user, usually a consumer. Okay, so wholesalers sell to the retailers. Retailers think, Costco, Walmart, whatever, that's a retailer. All right. Merchandisers buy inventory. Inventory is a current asset. Okay, when they buy the inventory, the amount goes into the inventory account until it is sold. When it is sold, the cost of that inventory is pulled out of the inventory account and put into an expense account called cost of goods sold. Cost of goods sold is an expense in the income statement, which we'll look at in a minute. Okay, so inventory, we start with what we had in the beginning, okay, which for review is the ending inventory from the prior time period. So the inventory on December 1 or December 31 is the same inventory on January 1. Okay, so the beginning inventory plus what we purchase during that time period equals the total inventory available for sale. Okay, so what you had plus what you purchased, that's what you have that you could sell. Now that amount ends up in one of two places. It either ends up in cost of goods sold, representing the things that you sold during that time period, and the remainder stays in ending inventory, which then becomes beginning inventory for the next period. This illustration tells you what you need to know about cost of goods sold. So remember, beginning inventory plus what we purchased during the year equals what we have available for sale. And then that amount ends up in either cost of goods sold or ending inventory. Hey, again, current asset is inventory, not yet sold. Here is a multi-step income statement that merchandisers use. Okay, merchandisers use a multi-step income statement. What we have seen up until now is a single step income statement. The single step just shows all the revenues, deducts all the expenses, get net income. But merchandisers want to see some of these interim levels of profit. Okay, we start with revenues, and as it says in the parentheses there, net of returns, allowances, and discounts. So those things that we saw in chapter 5, okay, gross revenues minus those things equals net revenues. And that's often what a published financial statement will start with. The internal ones, the management's going to want to see what those returns, allowances, and discounts are. But when we're publishing them for the outside, we often start with net revenues. Then we subtract cost of goods sold, and that net amount is called the gross profit. Okay, so that's the amount of money that we make after we've paid for the products that we sold. Then we're going to deduct our operating expenses, selling, general, administrative expenses, advertising, salaries, all of that stuff. Everything that is necessary to sell our products. We subtract those operating expenses to get operating income. Operating income tells us how much income did we make from our main operations. Okay, then we have this other category. Other can be revenues or expenses. Those are things that are not directly related to selling of our product. Okay, so gains on sale of investment, investment income, interest expense. Interest expense is not an operating expense, it's a financing expense. So it goes down in the other. And also for corporations, they have to pay their own income tax. It's its own line item. So what this does is it shows we made $1,854 from our operations. Okay, but then we had some of these other income and expenses, so that our net income before taxes was $1,816. Then we show the amount of tax that we paid to get to the net income. Thank you.